Hi everyone. So we're just waiting for everyone to join and then we'll start at sharp 3:30. Thank you. Good afternoon, ladies and gentlemen. Welcome to our webinar today on ESG and sustainable finance for the insurance sector. My name is Divya and I represent Capital Markets Malaysia. Today's program has been organized by the Malaysian Sustainable Finance Initiative, MSFI, which is an initiative by Capital Markets Malaysia, co-funded by the UK government through its Prosperity Fund and Capital Markets Malaysia. For those of you who are unaware, MSFI was set up to support capacity building for Malaysia's financial sector in the area of sustainable finance. We are supported by the ASEAN Low Carbon Energy Program with EY as its delivery partner. Today's program is 60 minutes in length and there are no breaks in between. The webinar is designed specifically for stakeholders within Malaysia's insurance and takaful sector. Today's sole presenter is Arina Kok, Partner of Climate Change and Sustainability Services in EY. She will address three key factors. Number one, demand and growth opportunities for the insurance sector in sustainable finance. Number two, potential sustainability and ESG risks and opportunities for insurance companies. And finally, on how to integrate sustainability considerations and ESG factors into investment decisions and product design. Arina's presentation will be made available on the MSFI and Capital Markets Malaysia website. You will also receive an email right after the event with the link to the presentation slides. If you have any questions at all during the presentation, please type them in the Q&A box down below and we will address them right after the presentation. So without delaying you any further, I'm very pleased to welcome today's presenter, Ms. Arina Kok, Partner, Climate Change and Sustainability Services from EY. Arina, over to you.
Thank you. First and foremost, I would like to give thanks to MSFI for the partnership and working Malaysia's Sustainable Finance Initiative, MSFI, working with us. So this workshop is delivered, as mentioned, with support of UK government's ASEAN Low Carbon Energy Program, which has contributed to MSFI in terms of setting up the platform and conducting various workshops over the last 1 year. We have continuously put up further support this year, and today's workshop is one of the efforts to drive the focus when it comes to green and sustainable finance in the region. So one thing to note is, maybe I'll share screen. Hold on. Let me know if you can see my screen.
Yes, we can.
Okay, thank you very much. So what I have put out today, the agenda for today's 1 hour, 60 minutes is, we've gone through the welcoming remarks. I think I won't go into detail because the focus is really on the substance and technical delivery. So what we wanted to go to today after the introduction, our topic today is sustainable finance for insurance companies, covering takaful as well. We will go through about, when it comes to the details, overview of sustainable finance landscape. So we'll talk about the market landscape, demand and growth opportunity in the market for 20 minutes. The focus is really to ensure that we are rebuilding a sustainable and inclusive recovery post-COVID-19 through sustainable finance. Second part of the forum would be discussing sustainable finance strategies for the insurance industry. Now, why this is important is to also build up awareness on what are the case studies on sustainable finance strategies and what kind of commitments of insurance that insurance companies are making and can make to drive further integration of ESG factors in investment decisions and product design. So we will also end with a Q&A and a polling question at the end of today. So if you have any questions as I go through today's presentation, feel free to add into the Q&A chat box, and I'm happy to take that at the end of the session. So for the first part, when it comes to the workshop objective, we kept it to 3. The first is really to understand the demand and growth opportunities of sustainable finance. Second is to understand the potential sustainability and ESG risks and opportunities for insurance companies. Third is to integrate sustainability considerations and ESG factors into investment decisions and product design. I'm sure the many of you who are dialing in have already experienced or have seen the enhanced regulations when it comes to central banks coming up with, like Bank Negara, who has come up with further guidelines when it comes to climate risk management and opportunities management. There has also been the exposure draft on climate scenarios that will be going through consultation for the next few days before finalized June. So there is a lot of efforts put in place to actually drive the integration of ESG risks and opportunities into financial institutions. So if we go into the first part of today, we're going to talk about this rebuilding a sustainable and inclusive recovery post-COVID-19 through sustainable finance. We'll talk about the why first. So with COVID-19 pandemic, along with the increased focus of climate change risks, we've seen major floodings happening on our shores in Malaysia as well, and for the global focus everywhere globally. But in Malaysia, what's critical to note is the rapidness, the severity, and the frequency of flood that has impacted Malaysia in various states, including last month, has demonstrated that climate change is very real and is very, down to our ground level here in Malaysia. So coupling COVID-19 impact and climate change, we have also brought up a few statistics from our EY thought leadership that is being issued on a global basis. Now, we have, through this investor survey, asked what are the opinions of companies when it comes to the adequacy of ESG disclosures that affects their current business model. Now, based on the survey, we can see that these percentages here outlines between 2018 to 2020, there is an increased feedback that companies do not adequately disclose the ESG risks that could affect their business models. The highest one comes on the governance risk, followed by social risks and environmental risks. And the percentages of inadequacy continues to go up over the past 2 years. Now, we also raised a survey on another context. We asked in the past 12 months, how frequent has a company's non-financial performance played a pivotal role in your investment decision making? Now, what we can see here, between 2018 to 2020, you see that 34% who said they have frequently used or at least looked at non-financial performance has increased to 43%. There is also a double-digit increase. And to a certain extent, what we are seeing on the right-hand side is a further outlining of what are the trends that is causing such an increase. So we can see here that trends that are placing ESG issues on the minds of governments, business owners, investors, and the wider community today. 52% investors identified climate risk and natural resources constraints to be the top 3 biggest threats for strategic success in the next 3 to 5 years. Now, climate risk is definitely a rising risk. If we see in the ASEAN region, Singapore has already implemented carbon tax in 2019. Indonesia will start their carbon tax next by 1st April, which is few more days ahead. And in Malaysia itself, there has been discussions about carbon pricing, voluntary carbon market that the governments and regulators are driving. So climate risk, when it comes to climate risk, physical and transition risk is definitely a mainstay that we know. Is a matter of timing and how it will impact economies. The other part is natural resource constraints. Now, what we are seeing is as the weather gets hotter due to climate change, definitely this will have impact on natural resource constraints. We will see potential food security, lower crop yields, as well as lower operational efficiency when it comes to the plants and so on and so forth. Now, the second part is 85% of investors also identified workforce diversity in terms of gender, race, and ethnicity to be of the greatest value to them as they assess human capital management. Now, it is important to note that regulators are also looking to enhance the diversity at the board level, hence the requirement to have at least one women director at the board level has also been announced by our Ministry of Finance in Malaysia as well. So the other point number 3 is 98% of investors are signaling a move to a more disciplined and rigorous approach to evaluate companies' non-financial performance. Now, why this is important? Because we are seeing a number of investors, whether it's pension funds, sovereign funds, or banks, or insurance agencies, when it comes to their investing strategies, they are already recognizing that the ESG risk does impact business resilience and performance. So because of that, a lot are putting in ESG screening criteria, but they're also putting in enhanced valuation when they look at valuating their assets or investments. Number 4 is 60% of millennial employees are willing to take a pay cut to work for a socially responsible company. We are in the current landscape. We've seen many organizations in a war for talent. So definitely for organizations that understands this war for talent, they are also looking to drive a socially responsible business concept to actually ensure that they're able to keep their talent as well. The 5th is we see $18 trillion global aggregate income by 2030 by millennials. That is the size of the market of a group inclined towards sustainable or environmentally friendly purchases. So the landscape of consumers will change, and we have already started seeing that in our more recent consumer survey report. So if we look at the next part, when you talk about the COVID-19, it has become the catalyst for sustainability-linked insurance products. And these are the 3 examples that we see in the market. So M General Insurance Berhad have came up with the insurance product, COVID-19 Test Fund, CTF, and the eligible claimant is civil society, policyholders, and Takaful participants, whereby the description is there is a total of 8 million ringgit to provide a fixed cash reimbursement for the cost of COVID-19 tests, up to maximum of 300 ringgit per test for policymakers and Takaful participants. Chubb Insurance Malaysia's Berhad have also come up with environmental impairment liability insurance for policyholders, where it offers up to 10-year term and available capacity of up to $50 million, covering remediation costs for pollution at insured locations, third-party insurance coverage for bodily injury, property damage, and remediation costs arising from pollution conditions caused during the transportation of waste or products. Now, Manulife Insurance and Berhad have also came up with similar COVID-19 test fund and a total of 8 million to provide fixed cash reimbursement, similar 300 for policyholders and Takaful participants. That is what we see in the market, but it's also a growing trend. Now, when we look at products aside, more can be done. And when we say more can be done, where would the focus area be? The first part we're going to talk about is the sustainable finance market in the insurance landscape. So when it comes to the ESG goals, it does provide a guidance for sustainable business decisions. So what are the main drivers of sustainable finance? What we have seen here is for sustainable finance, investors are more skeptical of financial markets and they expect more transparency over their investments and the impact they have on the wider world. Second is on sustainability focus. Long-term sustainable investment is a key focus of asset owners and private markets. Now, this is driving the increasing allocation of capital to ESG strategies. So when it comes to longer-term investments, ESG strategies are also more important and pivotal to understand the longer-term fit-for-purpose model that the businesses has. The other part is when it comes to the macroeconomy and geopolitical trends, there have been establishment of global frameworks such as the Paris Agreement, TCFD, United Nations Sustainable Development Goals, UN SDGs, as well as the more recently announced TNFD, Task Force on Nature-Based Financial Disclosures, Nature Impact as well. Demographic shift, we are seeing as baby boomers retire and pass their wealth on to new generations. With a stronger focus on long-term sustainable investments, more wealth is invested into ESG strategies. And last but not least, regulatory and industry standards. We see implementation of standards such as Principles of Responsible Investing, PRI, Task Force for Climate-Related Financial Disclosures, TCFD, and Sustainability Accounting Standard Boards, gaining focus and traction. One thing to note is, given the multiple ABC soup of frameworks, the good thing is out of the COP26, there is the formation of the International Sustainability Standards Board that will start to look at the convergence of sustainability standards to make sure that there is a certain streamlining of standards when it comes to ESG management and reporting. But when you look at the stakeholders' expectation, what are the roles or expectations of insurers' roles when it comes to sustainability and sustainable finance? So here we have outlined for customers. The next generation of customers do expect products and services to contribute to society. What we've seen from various researchers, consumer products marketed as sustainable grew 5.6 times faster. 61% is willing to pay more for sustainable products. I know this is debatable depending on different location, jurisdiction, and countries, but this is the statistics that was being done by the NYU Stern Center for Sustainable Business. The median saver would prefer a sustainable fund, even if it means having to sacrifice up to 2.5% of annual returns. Now, there is a fundamental concept or principle taught to it, because what we are seeing is there is a clear mindset shift away from short-term profitability that will result in not as sustainable long-term profitability towards a more stable and steady long-term sustainable growth when it comes to a sustainable fund. So there are a lot of mindset shift when it comes to customers, recognizing the impact, for example, like the impact of circular economy, waste management. So a lot of customers are taking all these into consideration when they drive their consumerism power as well. When it comes to on the right-hand side, investors, large investors and rating agencies are focusing more on sustainable finance. So funds and stock with high ESG scores outperform the broader market and trades at higher valuations. There are pressure around voting practices that is rising steadily, especially around climate change. We've seen courts taking companies or taking action against companies when it comes to climate change responsibilities globally, and that trend will only continue as more precedent cases come into light. The next part is when you talk about regulators, similar to what I've mentioned earlier. So sustainable finance regulations, including investments, non-financial reporting and disclosures, are continuously being enhanced on a year-by-year basis. Climate risk and disclosures, according to recommended frameworks like TCFD, is gaining traction, not just in Malaysia, but globally as well, as we see more and more countries signing up to be adopting TCFD as a national framework that they are working towards as well. When it comes to supply chains, including human rights, now it's important to note that we are placed in this current state of economies where human rights is going to be the center and focus aside from climate change. So there will be enhanced stringent requirements by not just regulators, but also investments or investors that will zoom and look into the human rights as well as supply chain management. So when it comes to society, civil society and non-profit organizations such as Principle for Sustainable Insurance and the Net Zero Insurance Alliance are important stakeholders for insurance organizations to interact with on a regular basis, because there are a lot of coordination, synergies, and knowledge sharing that are being driven at this point. There are also increased interest from campaigners such as WWF and Greenpeace around the insurer's climate strategy and approach. Why? Because there is a growing protection gap when it comes to what are the impact of disasters, climate disasters, versus the social protection when it comes to insurance that is supporting the stability of the economic factors. So why, with stakeholders' expectation growing, there's also a rising interest in ESG dedicated products. Now, a lot of stakeholders are now zooming into the how. We talked about the why, but the question is also on the how and what does it look like. So as we've seen here, there are a number of statistics, and what we've seen here is climate change is seen as the top 3 challenge that will negatively impact business growth. This is a survey that is done from 32% coming from CEOs, 28% coming from boards, and 44% from investors. This is our EY Center for Board Matters 2021 proxy season preview, what we're hearing from investors. What we're also seeing is 4 out of 5 consumers say they are planning to purchase goods and services from businesses they know have made a concerted effort to be environmentally friendly. 127 governments responsible for more than 60% of global emissions are considering or already implementing commitments to net zero. So from January to November 2020, investors in mutual funds and ETFs invested around US dollar to $288 billion in sustainable assets, and this is at a 96% increase over 2019. And on the right-hand side, the regulations are becoming stricter. Now we know the EU ETS for greenhouse gas emissions is up and running. There is a circular economy, eco-design. There are carbon and we heard as well on the EU carbon border adjustment taxes, CBAM, that will also be impacting those who are importing into the EU, whereby emissions will be taxed if the home country doesn't have a taxonomy. So if we go on to the next slide, now what are the regional and national initiatives when it comes to supporting sustainable finance? The ASEAN taxonomy for sustainable finance, this acts as a map to help guide capital towards activities that can promote the transition of activities in the real economy onto a more sustainable footing. Now, this taxonomy will also be the overarching guide for all ASEAN member states, complementing their respective national sustainability initiatives, serving as a common language for sustainable finance. And the taxonomy will help to aim ASEAN member state governments and investors to identify suitable economic activities in the Southeast Asian context and direct investment to fill a significant regional green financing gap. So what's important is to also understand what does this really mean, and how would the financing support things like climate risk adaptation, climate risk mitigation, what are the efforts that will help, what are the aspects of the projects that will qualify for green financing as well. Now, when we look at the Mutual Exchange Forum on Inclusive Insurance, MEFIN, this network is a collegial body of insurance policymakers and regulators in ASEAN with memberships from the insurance industry. This network serves as a mechanism for exchange of knowledge and ideas essential for the formulation of enabling policy, regulatory and supervisory framework, taking into consideration the unique legal and regulatory environment of respective country in Asia. MIFIN actually aims to also promote social and economic development in the region through globally accepted supervisory standards of the insurance industry. So the focus is really to have certain level of coherence, direction, so that there is no confusion when it comes to what are the standards and where the guidances are moving forward. Now, let's go a bit deeper dive when it comes to principles for sustainable insurance. What does it really mean? When we look at this case study on the right-hand side, it outlines an example from alliance screening process for ESG issues in insurance and investment transactions. Now, what you can see here, the purpose, we have the details on the left, but the purpose of this is really to have a resilient insurance industry based on holistic and far-sighted risk management, which ESG issues are embedded or integrated in the consideration. Now, why this is important and how this will be driven, it will link relevant industry standards such as the criteria of Dow Jones Sustainability Indices and FTSE4Good. These are the repository of information and insights that will be embedded into the consideration. What are the tools and outcome is insurers can become a signatory of the PSI, but they must report annually on their progress in applying the principles. Signatories account for more than 25 existingly. Those who have signed up for PSI accounts for more than 25% of the world premium volume and US dollar 14,000 trillion in assets under management. So the criteria to actually be a signatory is they agree on the sustainability measure. These are the 4. Decision making along ESG criteria, awareness raising on ESG criteria with clients and partners. So the characteristics of those who are signatories, they would constantly be providing further sharing, awareness, engagement with their clients and partners. And the third is collaboration with governments and regulators to promote action on ESG criteria. Last but not least, which is most important, accountability and transparency of progress in ESG implementation. Now, it is not a checkbox exercise. Quite a number of these criteria are very much principle-based. There are flexibility to actually provide what your journey looks like as an insurance that signs up for the PSI, but it's important to have clarity on how it's being integrated. So the example that I have on the right-hand side, what you can see is as they plan the insurance or investment transaction, each business unit will have its screening assessment, and they will talk about is there sensitive business areas that countries apply at the local jurisdiction? If yes, the business unit will apply the ESG sector guidelines or human rights guidelines for sensitive countries. And if no, then they will also look at what are the further action required for ESG. So they will start to look at the ESG risk detection. And when they go for further referral on what are the ESG center, they have a center for with ESG competency that will further deep dive on ESG assessment. So when they go under the ESG assessment route, there is 3 things that the organization does. One is ESG approval, or it goes for ESG conditional approval, subject to further information or mitigation measures. The third is if there is no further avenue, they would decline for ESG reasons. So it's walking away from their approval processes. So these are the example of screening mechanisms for insurance and investment transactions. Now, as we go on to the next part, I see some questions have come in, but maybe I'll just go on to the second part when it comes to greening of insurance products and services. We talk about sustainable insurance and products offered. A number of questions raised is, now what can be done and should be done or have been done? So the first one, as you see, based on the report that we've seen from Capgemini Invent, there is the pay as you drive where insurers are starting to look at varying the service offerings, where customer can choose a flexible monthly car insurance rate, which varies based on the miles driven. So it's not buying a long-term 1-year insurance contract, but it's pay as you drive. Second is when it comes to the LEED certifications, premium discounts are offered for homes that meet certain efficiency and sustainability standards. We do see these as a growing focus for developing countries because we do have a lot of buildings that are still not green buildings. So in order to ensure that there are avenues to drive green or sustainable finance, it's good to be able to strategize and target on where the retrofits projects are and providing premium discounts on some of the retrofits or development of homes that meet certain efficiency and sustainability standards. The third is on green rebuild. So customer can opt for an insurance coverage that replaces damages within an eco-friendly version. For number 4, property loss mitigation. So premium discounts of credits may be offered to homeowners to install mitigation device or climate resistant construction techniques in climate risk prone area. Now, why this is important? Because we are also seeing property developers starting to look at development at coastal area needs to manage the risk of sea level rise as well. So these are the kind of questions that insurance can start to ask. Now, what are your mitigating or adaptation factors when it comes to assets or properties that are at high climate risk prone areas? Number 5, green behavior discounts. Consumers can receive premium discounts if they can prove that they purchased hybrid or electric vehicles. So there is a certain level of tagging or at least identification of green assets before they decide whether a premium discount can be given. Number 6, green building restoration. One thing to know about number 5 is we've also heard about Singapore banning the imports of internal combustion engine vehicle, ICE vehicle by 2040. Now, definitely, if we put on the thinking cap, if some of the imports will be banned, even cars that are not efficient or non-EV cars may potentially become stranded assets in the forward-looking context. So to a certain extent, offering the premium discount in a way will also spark the meeting the expectations or needs of customers who are pivoting to green assets, and it also helps the organization to reduce the risk if there's a potential risk of stranded assets that insurers will historically have been insuring as well. The idea is the timing, the extent, and what action are insurers taking at this point. 6 is green building restoration. So in the event of a total loss, the policy will cover the cost of rebuilding as a green certified building. So this is green building restoration strategy. Now, when we come to the insurance industry, to close the protection gap, this is a very important focus area as well, because this essentially, if we talk about fit for purpose business, the fit for purpose business for insurance is to manage the protection gap as well. What we are seeing in the key trends that can be deployed by insurance is to also consider the massive natural catastrophe related protection gap, which now accounts for $221 billion in 2020, with catastrophe losses at 29%. And based on the key trends, these are benign. So we see that a lot of insurers are adopting, as I mentioned, UNEP FI PSI principles for sustainable insurance to embed ESG issues in insurance decision making. Quite a number of them have started to commit to become carbon neutral by 2050, offer preventive and recovery or post-event services, encourage joint responsibility across government, insurers, and individuals to come and collaborate and have a joint responsibility towards closing the protection gap, implement risk management and risk prevention, for example, risk modeling and pricing. Now, it's important to note that insurance would have a number of quality data when it comes to risk management. So I'll talk about that in a bit later, but what's important is with this data, it is where insurance would also be well positioned to actually address what are the risk management and risk prevention strategies when it comes to their investing and also their insurance activity strategy. On the other hand, what we're seeing is also a trend where some insurers are going towards seizing or restricting insurance coverage for correlated assets, and some are actively divesting from certain asset classes. So this is a form of strategies insurance are taking to support or risk manage what we call the stranded assets risk. But quite a number of insurance are starting to look at transition strategies. So it's also to look at what are the transition factors that these companies are taking when it comes to some of these potential assets, brown assets, and develop a mechanism that allows the transition to green business model as well. At the bottom is to collect continuous real-time climate data. So the question typically we ask is based on the flood that has happened, 3 times over the last 12 to 16 months. What are the real-time climate data that the insurers have been collecting, tagging, and what are the analysis that has been communicated or shared with strategic stakeholders to drive and inform decision making? Next is really to provide innovative insurance products in response to climate change. I talked about it earlier, the examples, and to also improve climate disclosures. Now, why improvement of climate disclosures is important? When we look at the leaders, some of the global insurance players, they've already started to provide a purview of where the climate risk is affecting geographical locations, whether it's wind, flood, sea level rise. There are already improved climate disclosures because that's the right thing to do when it comes to supporting the ecosystem on protection gap. So when it comes to the integration of ESG factors in investment decisions and product design, we have, first we're going to talk about building resilience through sustainable finance. So when it comes to the macro trends driving the risk landscape evolution, what we're seeing on the micro trends is changing business environment. We talked about that. What's important to note from this point is there are emergence of tech-based firms and new business models that will create risks that can't be overlooked. So what we are seeing is the focus in technology when it comes to changing business environment. Second is evolving social and demographic trends. So given the lifestyles of different demographics are very widely and it's also evolving, societies shift in demographics, for example, the silver tsunami and an increasingly tech-savvy population. Those are things that needs to be taken into consideration when driving sustainable finance. When it comes to the technological advancements, what we are seeing is artificial intelligence, connected devices, nanotechnology that has not only exposed humans to risk related to data security, but is also altering the very nature of risk itself. So definitely there would be areas and focus of advancement if deployed accurately and effectively. For example, it can be deployed to support some technologies can be deployed to support early warning mechanism. Before a flood happens, there is already mitigation or at least advancement to inform to reduce the risk and damages that it impacts economy and insurers. On the other hand, we are also seeing disruptive environmental patterns. So there are concerns on the increasing frequency and severity of cyclones and wildfires. This is very much more on the other countries like Australia and Europe, and the scarcity of natural resources, increase in micropollutants, including plastics, which are also growing. So we do see a number of plastic-related regulations similar to Malaysia, the zero single-use plastic roadmap that has been implemented. Those will also be the trends in the risk landscape. And if you see here on new medical and health concerns, these are also the aspects when you talk about resistance to antibiotics, new viral threats, and escalating lifestyle-related issues. Those are the focus areas in driving the landscape evolution. But what's important is when we come to the climate change, we have to have a way to measure, evaluate, assess, and stress test some of this risk So when we talk about that, how do we then now cascade into the deeper dive of physical risk and transition risk under the climate change risk as well? So one thing to note is climate change definitely is a source of economic and financial risk, but within climate change, it is categorized. Physical risk, you have the climate related, whether it's extreme weather or chronic weather. You also have the environmental, which is water stress and pollution, resource scarcity. Under the transition risk, you have the climate related, whereby you have policy and regulation like carbon tax, carbon pricing, technology and innovation. For example, you have smart metering that will also drive energy efficiency, and you have the market sentiment as well. On environment, it's the same. You have the policy and regulation and innovation. So underneath the physical risk and transition risk, we outline what are the risks affected, such as credit. Definitely the focus is on the probabilities of default and the loss given default, PD and LGD, of exposures within the sectors or geographies susceptible to physical risk will be impacted. For transition risk, it will be the stranded assets that I talk about, and the rising issue of greenwashing, which may lead to higher probability of default as well as lower collateral, considering the lower collateral values. Under the market risk, we talk about under physical, it will be shift in market expectations, considering the sudden changes in pricing, higher volatility, and losses in asset value in some markets. Where else for transition risk, it would come as a form of this transition risk drivers may generate an abrupt repricing of securities and derivatives, for example, products associated with industries affected by asset stranding. On operational, physical is definitely damage to properties, branches, data centers. On transition risk, we are seeing changing consumer sentiments and lagging behind new green activities and technologies. For other risks such as liquidity, business model, definitely for physical risk is higher insurance certificate cancellations to supplement the loss of income. And when it comes to transition risk, it could be the viability of some business lines that lead to strategic risk of specific models if necessary adaptation or mitigation needs, diversification is not implemented. So this provides a holistic view as well of what an integrated dimension of sustainable finance looks like, hitting the full business model of a financial institutions. On the left-hand side, what you can see is, given the various key stakeholders, if you talk about what needs to be, who are the key stakeholders that needs to be managed, definitely you have the shareholders, policy holders, business partners, politicians, and regulators. Now, what's important is to also look at within the key internal stakeholders, you have the various C-suites, and under the essential dimensions, you have the governance, strategy, risk management, products, and investment management. Now, what's important to note is underneath the holistic sustainable finance, there are focus areas. So when you talk about the focus areas, is to also look at, from the context of risk management, for example, is to embed ESG risk in risk management. What are the new terminologies, new regulatory requirements, and how this is embedded into your risk management, enterprise risk management, ERM. And when we talk about investment, is to also look at what are the counterparty analysis, what are the new risk dependencies, new risk concentrations. When it comes to products, what are the product innovations that I mentioned earlier, change in service partner behavior, and what are the new market opportunities? When it comes to strategy, it's also considering new data sets, new business activities, such as where in markets that have enhanced, increased EV infrastructures, those key players who are entering into carbon capture or potential hydrogen economy, what are the strategies that can be deployed to support this business transition as well? So when it talked about strategies, there are even further 6 areas on ranging from creating new products to introducing new policies by insurance companies. So there's many multiple ways of integration, but here are the 6 that we can consider. So under the product, we also see the insurance companies are increasingly responding to growing appetite and ethical and sustainable practices. So for example, Tokyo Marine Group, they offer the cyber risk insurance, which aim to contribute to smooth business activities through new products and services. For internal policies, most are transforming their internal operations to be more inclusive and environmental friendly. So for example, Allianz has established dedicated ESG task forces to integrate sustainability matters across the core processes in the organization. So for impact investing, what we are seeing is AIG, for example, has a total of 3.2 billion invested in private wind, solar, geothermal, hydroelectric, generation and transmission projects, solar power purchase agreements as part to bring positive social or environmental impact. For distribution, what we are seeing is in the way insurance companies are distributing services to their retail customers, Allianz Taiwan Life Insurance created an AI, artificial intelligence powered virtual assistant that can interact with customers in a very human way. Now, this has become quite a common feature for most insurance companies. And when it comes to collaboration, this example is Allianz have collaborated with International Finance Corporation, IFC, to support the global transition to a low carbon economy across market as well as serving customers' interests. On policy, Manulife have developed municipal bond ESG framework to analyze ESG risks in their municipal and securitized fixed income assets. So what we are seeing is in order to also achieve risk-adjusted long-term financial returns through integrating sustainability risks and opportunities into investment decisions, these are also what we are seeing for Zurich. What they have done is to provide adequate and regular training, understanding the economic importance of ESG. So they enhance asset managers' awareness of risks and opportunities linked to ESG factors when making decisions on securities and asset selection. They've also provide portfolio managers and investor analysts access to ESG platforms and relevant information such as ESG analysis, ratings, and data. This will naturally encourage portfolio managers to leverage on this research to provide provided by brokers in investment securities and asset selection. Process integration, there is a clear understanding on how the integration of ESG into asset valuation and decision-making process for certain security of assets. So this integration into, will consider exposure, for example, to controversial business practices and have that also into the security selection decision process as well. So it varies cut across different sectors, but there are industry sector analyses to support the process integration. So what is very much focused for shipping, oil and gas could be different from agriculture. So to some extent, these are the diverse approaches that has been taken and what we've seen. On active ownership, active management of ownership. So what they've done is also work closely with portfolio managers, ensuring the requirements for ESG integration are reflected in the investment processes. So the last part that I have here is case studies. Now, why it's important is to also see how others have already started to embed sustainable finance strategies and commitments for insurance companies. So the first one, what we're seeing here is under the UN Global Compact SDG Industry Matrix. What we're seeing here is these are the various areas that can be contributed by financial institutions. The ones that comes up are financial inclusion, sustainable agriculture finance, investment in healthcare, so on and so forth. On the right-hand side, I think this is also to show when it comes to setting decarbonization commitments, that's also one of the strong factors, because if we look at the decarbonization commitment, it's as good as calculating the emissions from your operations and your activities and aim towards either a carbon neutral, carbon negative, net zero, or science-based targets. So we've also understand that there are a lot of questions surrounding what's the difference between carbon neutral, negative, net zero, and science-based targets. We've outlined at the bottom the examples under each scenario. So carbon neutral, where you have the offsets and removal mechanisms, whereas for carbon negative, whereby the SBT set and residual emissions are lesser than the offsets of removals. So you actually have negative. And for net zero, the science base is achieved and residual emissions equals to removals. And when it comes to science-based targets, the key thing is very much Paris aligned greenhouse gas reduction targets. And there is already a review and has gone through the SBTi review as well. So one of the case study that we've outlined here is the global insurance leaders joins the newly formed Net Zero Insurance Alliance that is widely talked about. So what we see in this effort is 8 leading insurers. They have joined this NZIA, convened by the UN Environment Programme's Principle for Sustainable Insurance Initiative, the PSI. And the focus is to contribute to the goal and activities of the UN Race to Zero campaign and the Glasgow Financial Alliance for net zero. So this network is a network to discuss underwriting business, to underline the importance of what are the corporations that leading governments and companies needs to do to mitigate risks of climate change. The members are also setting measurable and science-based climate targets, which will be updated every 5 years. So the first target is expected to be reached by 2025, and all members will report on an annual progress basis. Now, the benefit of this is industry players will now work together with insurance associations, regulators, trade bodies, and all to seek a consistency in regulatory and supervisory policy frameworks with net zero transitions. So if you say someone is going towards net zero, there is a consistency of what that looks like. In terms of the members of NZIA, they will also develop and offer insurance and reinsurance product solutions and arrangement for low emissions and zero emissions technologies, nature-based solutions that are likely key, the big bets, to achieve net zero transition. So they will provide that support from an insurance and reinsurance perspective. The Alliance will also advocate to engage in governmental policies for a science-based and socially just transition of economic sectors to net zero. Now, what this means is there will be further sharing of information that insurers have within their databases to support and benefit the broader economic ecosystem. The impact is the members of this alliance believe that the global insurance and reinsurance industry can play a key role in the transition to a resilient climate-friendly economy in line with the Paris Climate Agreement target. So the next one that we have is this case study on Allianz Press Global Investors Sustainable Investment Drive. Now, in March last year, Allianz GI, one of the world's largest active investment managers, announced an additional 74 equity, fixed income, and multi-asset funds that will become sustainable. And this is at about euro 70 billion assets under management. The portfolio is constructed using ESG assessment, reflecting clients' values through the minimum exclusion strategy, whereby it will have strengthened engagement approach to what it means. And they call it the socially responsible investing, SRI, best in class considerations. They've also launched a new stewardship strategy, climate engagement with outcome approach. Now, why this is important? When there is a clear outcome, there's a clear way to drive transition. Now, what the strategy aim is to engage where fund managers will actively engage with the top 10 absolute carbon emitters, scope 1, scope 2, within their portfolio as a proxy for climate impact. Now, we've seen the same similar strategy being applied in our region as well, whereby the focus is really starting with the top 10 carbon emitters. Once there's a clarity on the transition, the strategy will be also shared and deployed with the broader sector as well. So if, for example, it's in the utility or oil and gas, there is a scale of what are the strategies that works for the ecosystem. And the benefits is where Allianz GI, their effort is really to help shape the asset management landscape by innovating and anticipating growing client demand. So there's a shift from being reactive to a very clear, proactive and targeted focus area on where they can make the most impact. So this new stewardship will help to set engagement targets. For example, what they have outlined is greenhouse gas reduction targets or board level remuneration target linked to climate change, which is also another trend that we're going to see in Malaysia, given companies have also started to embrace integrated reporting, linking ESG holistic performance to remuneration. So issuers, what we're seeing globally and the local trend is the focus is how they are doing it. They do not respond to requests or fail to requests whereby there is a failed effort on improvement towards the climate pathway, and they would exercise divestment if they need to escalate the process. So this, what they have done is to take a more active role in shaping or responding to climate change, and this will help to open up the dialogue between companies and the insurers to encourage them to share their views and strategies as well. Now, if we look at the other case study here, the Mongolian index-based livestock insurance project. Now, this is a traditional insurance where it's often not available in sparsely populated areas of Mongolia. So the livestock are exposed to extreme climatic conditions, which increasingly threaten rural livelihoods. So in 2005, the Mongolian government entered into a credit agreement with the World Bank to implement the IBLIP, an index-based insurance program. It incorporated risk layering, whereby individual herders bear the cost of small losses, the first 6% that do not affect the viability of their business. The larger losses are transferred to the private insurance industry, the next 24%. The final layer of catastrophic loss, above 30%, is borne by the government. Now, this insurance is provided through partnering with local private insurance companies, and the payout is whenever the mortality rate exceeds a specific threshold. And why this is important, again, is the protection gap. It combines the self-insurance, market-based insurance, and social insurance, whereby the herders are incentivized to manage and invest in their livelihood activities. There is a low administrative cost for insurance companies, secures indemnity payments to insured, and it opens the market for private innovation and reinsurers. The impact is IBLIP can provide financing for adaptation projects related to climate change by lowering the cost of the insurance to cover low-income markets. So since the inception in 2006, the IBLIP premium has increased every year, reaching a total premium of 1.8 billion in 2013, with voluntary participation of 19,447 herder households from 21 IMAX. So this is the provinces. So this is just to give everyone a view of how the product has been co-developed with the stakeholders. The other case study we've seen here is MS and AD Insurance Group, whereby they have integrated 17 sustainable development goals into its products and services to support the industries required to realize a sustainable society. So they are contributing to SDGs through risk consulting services, insurance, and other services. The group has underwriting criteria adapted for respective product and services as part of risk assessment process. Comprehensive process includes system verification, which has been implemented, and underwriting decision, including the board's approval made based on ESG risk evaluations. The group examines the value generated by the product and services to strive to create value shared with society. Now, how this benefit is, it developed an internal process for underwriting to confirm the transactions are in accordance with the context stated in the group policy, and consideration to underwrite and make investment only relevant projects aligned to the ESG assessment, confirmation of compliance within the group policy. So there is a channeling that has been done internally. Now, such transactions are also being considered for escalation processes and are reported to the group sustainability committee based on judgment of senior management of responsible section for ESG. The impact is this product aimed to further contribute the resolution of social issues that reach about 51.7% of premium written in non-life insurance business in 2020. Now, MSAD will not undertake projects related to construction of new coal-fired power plants or underwrite or invest in companies that manufacture cluster munitions, which are inhuman weapons. So before we end, we have the Q&A, but maybe I'll pass back to MSFI to take us through the feedback form. If we can actually kickstart a quick polling before we take on the questions. Thank you very much for staying, and we hope today's sessions have benefited everyone, at least from the very targeted case sharing focus that we've provided. So we hope to get your feedback, and this will help MSFI as well as us to support some of these questions that you have raised. Sharing. Tivia, are you there? Maybe you want to. Yeah, I think we want Michelle to take through the polling. The first one,
okay.
Yeah. So maybe Tivia, you want to take through the polling?
So should we move on to Q&A then once the poll has ended?
Sure.
Okay. Michelle, can we end the poll so Arina can begin with the Q&A session? Thank you. Okay, Arina, you can begin Q&A.
Sure. So I think we've received quite a number of questions. The first one I think we see is, thanks for bringing up the various requirements from different standard setting bodies, rising interest from different stakeholders and regional and national interests. However, can you relate all these factors in the context of insurance business in a holistic and integrated basis? Further, when you use the term ESG, which is different from Bursa listing regarding sustainability, how do you reconcile ESG and EES? So I think we get this question a lot when you talk about environmental, social, and governance versus the economic, environmental, and social. The difference distinguishment is typically we look at it from a holistic environment, economic, social, and governance. For Bursa, the focus is on E, E, and S because governance have a very strong focus maintenance, or at least within the Bursa guidelines. Governance has a full chapter on itself before we go into the economic, environment, and social aspects. So that's why for Bursa, they go for the E, and S, but the G is not left out. The G is the integral part of Bursa guidelines. So if we take the Bursa guidelines and we see, although it's mentioned EE and S, the G is a mainstay there as a foundation. So there is a EESG. Globally, there is a discussion on ESG because economic has always been a mainstay of the heart of why business are being driven. So the ESG is to embed the environment, social and governance, connecting them to the financial, which is the economic. So I do understand the confusion, but hopefully this also provide for some who's trying to get a clarification between the EES by Bursa versus the ESG that most global frameworks are aligning. So if to avoid the confusion, typically you want to look at it from a holistic economic, environment, social, and governance. Now, if you look at any guidelines, this four will be there regardless. So the other questions that was raised is, how can brokers play a part in working with insurers to help our clients? At the moment, it seems only the international insurers are developing green insurance products. However, there is a lack of product development related to ESG or green insurance products in Malaysia. Now, this is a very good question because as what we've shared, the purpose of this webinar, or at least this development, is really to bring the examples of the green products and where others have collaborated, use cases to share down to the ground level of how the green products or social ESG products can be collaborated to be developed. So today's forum is really to provide the awareness and partnership discussion. So what we really hope is the key takeaway from those who have joined and benefited from here can also go back and really get into the discussion within your insurance and Takaful work streams to actually discuss further on the product and innovation. So I know we have covered quite a number of questions within the presentation earlier. I understand the question came in gradually as I went through the discussion. So feel free to reach out to MSFI as well as EY ourselves if you have further questions. Thank you very much for those who have joined. Apologies for the slight overrun, but we really hope you have taken back some valuable discussion points from today's session. So maybe Tivia, back to you.
Thank you for that very, very comprehensive presentation and overview on ESG and sustainable finance for the insurance sector arena. Ladies and gentlemen, we've come to the end of our webinar. We'll see you soon. Thank you.